In August of 2015, the S&P 500 experienced a 10 to 11% waterfall decline. In this week's video, we'll be looking at similarities and differences between the August 2015 pre-plunge period and February 2017. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Regular viewers of these videos may remember in late January, we covered the mother of all stock market signals. Let's provide a quick update. We all remember that there was a long-term consolidation box in the NYSE composite from 1965 to 1982. You can make an argument that we have a similar box, a 19-year consolidation box from 1997 until the breakout here in calendar year 2016. And we know from past videos that often harder markets are followed by easier markets, and in this case we saw big gains from 1982 to calendar year 2000. If we fast forward to Friday, February 10th, 2017, you can see the NYSE monthly, we still have easily a breakout above the orange box here at point A, and we also are holding a breakout above these levels here at point B. And clients and regular viewers also know that we've been covering numerous bullish developments dating back to August 5th. These are the titles of the videos. You can find them if you Google these titles here. In the remainder of the video, we're going to examine the question using charts. What are the odds that we see a dislocation or a waterfall decline similar to the dislocation and waterfall decline that occurred in August of 2015? It's a February 8th tweet from Ryan Dietrich. Here's his Twitter handle. It's a statement of fact. Investors Intelligence bears, that's percent bears, lowest since August of 2015. That was right before the first 10% correction in nearly 4 years. In this segment of the video, we're not questioning the validity of this tweet. It's simply a statement of fact. Ryan's not making any predictions about 2017. Therefore, what we'll do is say, how concerning is this? How similar, other than the Investors Intelligence Survey results, is the present day to August of 2015, right before a 10% plunge? And while we answer those questions, we'll gain some valuable and general insight into the market's present day risk-reward profile. Before we go to the next slide, remember the plunge came in August of 2015. And if you go back and look at history, the plunge actually began after August 18th. This is the S&P 500. This is April of 2015. This is August 18th here. The S&P was trading roughly at 2100, and you can see we had a sideways consolidation pattern. This is our high risk profile before bad things happened. If we fast forward, this is the 10% plunge that Ryan referred to in his tweet. We dropped from 2100 intraday down to 1867. In terms of assessing risk in the present day, we really don't care about the profile on August 24th. It's more helpful to compare the profile before bad things happen to the present day profile. So as we move forward, keep in mind August 18th is the day before bad things happened. And we'll use some generic and even-numbered moving averages to help us assess the risk-reward profile before bad things happened on August 18th, 2015. This is the S&P 500 daily. We've removed volatile price so we can focus on trends. This is the 30-day exponential moving average in blue and the 50-day exponential moving average in red. We can interpret moving averages just like price. So the moving averages in June make a high, then we make a discernible lower high, another discernible lower high, another discernible lower high. And as of August 18th, we still haven't exceeded any of these highs. This is a weak look from a momentum perspective. And we also have in hand, before bad things happened, a bearish moving average crossover. This is a bullish profile here. Blue is above red, and the slopes of both of the moving averages are up. Here, this looks different. Now blue has moved below red. This is a higher risk look from a probability perspective relative to the look over here in April of 2015. How do the exact same moving averages look in February of 2017? The answer is quite a bit better. This is February 9th, 2017, and instead of making a series of discernible lower highs, we're making a series of discernible higher highs. Instead of blue dropping below red in a concerning manner, blue is well above red in the present day. This is telling us that the present day trend, as of February 9th, is significantly stronger than August 18th of 2015. Remember, sentiment was similar here. We have a high degree of bullish sentiment here and a similar high degree of bullish sentiment here. The difference is people are optimistic here as the market's profile is waning. People are optimistic in the present day, but the market's profile is significantly better from a risk-reward perspective than August 18th. Extreme and bullish sentiment coupled with a weak profile is concerning. Bullish sentiment coupled with a bullish profile is not nearly as concerning. In the charts that follow, we'll use the same moving average pairs, so we'll be able to move a little bit more quickly. And keep in mind, August 18th is the look of the charts before bad things happened. Similar situation here. Now we have a risk-on, risk-off chart, or stocks, SPY, in the ETF world, relative to AGG, or a diversified basket of bonds. We have a discernible lower high, and clearly we have waning momentum here. Blue is well above red over here, and here they're kissing. Typically we get big moves when moving averages start to cluster. The move can be up or it can be down. In this case, in 2015, it was down. This is the look of the moving averages before bad things happened. This is the look of the moving averages after bad things happened. So if this is the we better pay closer attention look before bad things happen on August 18th, how does the same chart look today? The answer is almost infinitely better. Instead of making a lower high and having the moving averages in kiss mode here, we're making higher highs, and we have a lot of white space indicating a much stronger and sustainable trend from a probability perspective here relative to August of 2015. Here we're looking at AGG, the diversified basket of bonds. We move to a maximum fear state, TLT, or long-term treasury bonds, tend to be the winner. If you look at ETF performance in bear markets, TLT typically does well. Similar concerning setup. We had clearly have a bearish moving average crossover here before the plunge occurred in August of 2015. How does the same chart look today? The answer is quite a bit better. These are powerful charts here. We can use markets, the broad NYSE composite, which is broader. It has more stocks than the S&P 500, and it has quite a bit more stocks than the Dow, which has 30 stocks. Therefore, market breadth can be measured looking at the NYSE's performance relative to those narrower and major indices. You can see here on August 18th of 2015, market breadth is waving all types of yellow flags before that waterfall plunge. I can see this. This is a negative trend here telling us that fewer and fewer stocks are holding up. The major indices are holding up, but the broader index is already broken down before the waterfall plunge. Do we have a similar and concerning and waning look from a breadth and broad NYSE composite perspective in calendar year 2017? Said another way, how does the exact same chart with the exact same moving averages look today? February 9th, quite a bit better. This is telling us that market breadth is quite a bit better in the present day than it was here. Market breadth started to wane in May of 2015. The waterfall plunge didn't occur until after mid-August 2015. We can look at numerous charts, and they'll pretty much all paint a similar picture. August 18, 2015, this is risk on, risk off. In this case, the S&P 500 index relative to the VIX fear index. We have a discernible lower high here, and our moving averages have not made much progress going back several months. This is somewhat of a consolidation box with a lower high on August 18th. Rather than moving sideways and consolidating, we have a bullish moving average crossover and a discernible and more favorable bullish trend in favor of the S&P 500 relative to the VIX as of the close on February 9th, 2017. A discernible lower high relative to this high. We're making a series of higher highs and higher lows on the right side of your screen. Similar situation here before, well before the waterfall plunge began after August 18th, 2015. In May, base metals, which are economically sensitive relative to defensive consumer staples, peaked in May, gets the bearish moving average crossover, waving yellow flags well before the waterfall decline. How does the exact same ratio with the exact same moving averages look in February of 2017? The answer is quite a bit better. Just as this chart here can't predict the future, the charts that we're showing as of February 9th, 2017 cannot predict the future either. This chart can help us with probabilities. The present day chart can help us with probabilities. The probability of bad things happening relative to the probability of good things happening is higher here than it is here. Conversely, the probability of good things happening relative to the probability of bad things happening is better on the right side of the screen relative to this period here on the left side of the screen. We're not making any predictions here. We're simply looking at facts in hand as of August 18th versus facts in hand as of February 9th. We can take a broader sector look. This is SPHB, SP high beta, or economically sensitive sectors relative to SP low volatility or more defensive sectors. August 18th, well before the S&P 500 broke down and plunged. We have a bearish moving average crossover. We're making a series of lower highs and lower lows with the moving averages, telling us that the conviction to own defensive-oriented stocks is picking up relative to the conviction to own economically sensitive stocks. This is a waning momentum look from a bullish perspective. If we fast forward to February 9th, 2017, sentiment is similar here to the present day, but the market's risk-reward profile in the present day based on facts in hand, no opinions, no forecasts. We're simply looking at facts. This is a more favorable look from a probability perspective than the look that we had before the waterfall plunge in August of calendar year 2015. Can't emphasize enough, those of you that watch these videos on a regular basis, you know we respect Ryan's work. So our objective there was not to say anything about Ryan's work. We were simply looking at a factual tweet and asking how concerning are the facts that he presented on Twitter. This is a separate analysis from Ryan, and this is a quote from one of his write-ups. January 2017 didn't have a single 1% close lower and not one day was negative on a year-to-date basis, meaning we never flipped into negative territory year-to-date in the month of January. The month finished on a positive note in green territory. When those criteria have been met in the past, the rest of the year was higher all 6 times and saw an average return of more than 15% with nearly an 11% median return. Net bottom line from Ryan's research here, typically when you see a January similar to the January that we had in 2017, good things happen typically for the rest of the year. We can also use Twitter to gauge sentiment. Notice, this is Ryan's tweet that we started the video with. It had 45 retweets and 65 likes. This appears to be a bearish tweet. It's telling you that the present day has something that's similar to a period that immediately preceded a 10% drop in the stock market. Therefore, we have a lot of votes of confidence for the potential for something bearish to happen. As a reference point, we went and looked at Ryan's tweets immediately before this tweet and immediately after. If the vast majority of people that follow Ryan on Twitter were bullish, we would expect bullish tweets to get more retweets and more likes than this tweet. If the majority of people would prefer to see bearish outcomes, we would expect to see a higher number of retweets for this bearish tweet and a higher number of likes. Thus, did the tweets immediately before and immediately after this tweet get more or less than 45 retweets? The answer is quite a bit less in the unscientific poll. 3 retweets, 8, 4, 11, 9. From a sentiment perspective, we would be more concerned if Ryan tweeted something bullish and he had 220 retweets and 100 likes. That would probably be indicative of overconfidence or excessive levels of bullish sentiment. The unscientific poll with the retweets says basically just the opposite. We're getting a lot of votes for the potential for something bad to happen. The percentage of respondents to the Investors Intelligence poll, the percent bears in the present day, is the lowest since August of 2015. What about other sentiment polls? Are they also skewed toward excessive optimism? When this tweet came out on February 8th, we checked the latest American Association of Individual Investors Investor Sentiment Survey. The historical average for percent bulls is 38%. The historical average for neutral is 31%. And the historical average for this poll for bearish responses is 30%. Therefore, if we were looking for excessive bullishness, we would expect the present day number to be quite a bit higher than 38 here, and we would expect the present day number to be quite a bit lower than 30% here. As of February 1st, 2017, rather than having excessive bullishness, the percent of respondents coming back with a bearish response is actually currently above the historical average. The historical average is 30%. The percent bears in this poll was 34%. And more importantly than these numbers here, or these numbers here, the real voting mechanism in the market, which tracks the conviction to own stocks relative to the net aggregate conviction to sell stocks. The facts that we have in hand today look quite a bit better in 2017 than they did in August of 2015. Obviously, all of the charts on the right side of these slides, all of them are subject to change. We're not making a prediction about what's going to happen next. We're simply looking at the facts that we have in hand. That's how we make decisions, with facts rather than opinions or forecasts. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.